What is up? Welcome back to another video. In this video, I'm going to be talking about liquidity and everything you need to know to be able to master trading liquidity. Now, liquidity is one of the most important things when it comes to trading and especially ICT concepts. And the reason for that is because liquidity is the reason why the market moves in certain areas. For example, let's say we have a really strong pool of liquidity right here. Price is most likely going to come and take that liquidity before moving in its intended direction. Okay, so there are three main types of liquidity, and I'll be going over every type of liquidity in this video. So, the first liquidity that we are going to talk about is one that some of you might not be familiar with, and it is called trendline liquidity. Now, you might have heard this as low resistance liquidity or low resistance liquidity. So all it is literally trendline liquidity. So let's say we have a trend line that looks like this. Okay, we are just trending in a certain direction. Okay, the trend line liquidity is pretty self-explanatory. So all it is when there are lots of stops resting below or above a trend line. Now, if you don't actually know what liquidity is, then all liquidity is just where buy stops and sell stops are resting in the market. Okay, so let's use this trendline liquidity as an example. As you can see, the price has tapped into this area lots of different times. Okay, obviously imagine that these lines are all candlesticks and this is price action. So let's say that price has tapped this area here, it's tapped it here, it's tapped it here, it's tapped it here. Okay, so we have a perfect trend line right here. Now, what the market makers will like to do is take this liquidity. Even if we are still going to go up in the longer term, what the market makers will want to do is come down and take this liquidity. So all underneath here are all retail traders stop losses. Okay, so all the retail traders are going long here, they're putting their stop loss somewhere like this, then they are going long here again on this trend line like that, stop loss there, they're going long here on this trend line again, stop loss below, and the same again here. So they keep going long off these off this trend line. Okay, now that means that there is lots of sell side liquidity here. Now this is sell side liquidity because this is sell side stops that are here. Let's say that the trend line was coming down and we were targeting liquidity above, that would be called buy side liquidity. Okay, so now let's imagine that price action wanted to reach this box up here. We don't know why it wants to go up here, but let's just say price action wants to go up here. We know that there is lots of liquidity sitting here in this area. Okay, so what the market makers might want to do is actually come down, take this liquidity, and then end up going back in its intended direction. Okay, so when you see trend lines in the market, obviously we don't trade trend lines as ICT traders, but when you see trend lines in the market and you see it break and then instantly come back up, that happens a lot in the market. And the reason for that is literally just because price action is grabbing liquidity. So when you hear me or any other traders talking about grabbing liquidity and then keep going in its intended direction, so if someone says it just grabbed liquidity or it swept liquidity, all that means is it just wiped out the liquidity and then went back in the other direction. Okay, so let's say we had a trend line that looked like this. So we had lots of buy side liquidity and we had lots of sell side liquidity. So right here we have a trend line that looks like that. So as you can see, as well as this trend line hitting down here multiple times, the trend line has also hit at the top multiple times. It's here, 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 here. So the retail traders, as well as opening long positions all here, every time it hits down here, they are also opening sell positions when the price action hits up here, because retail traders trade trend lines. Okay, so what will the market want to do in this situation? Now, most likely what price action will actually like to do is take both liquidities and then go in its intended direction. So let's say our bias was bullish for today. What price might want to do, and this is why most retail traders end up losing money. Price action will come up, sweep the buy side liquidity, come down, sweep the sell side liquidity. Now every retail trader has just been swept out the market, as well as all the retail traders entering lungs here. They're also probably entering shorts right now because the trend line has broken, and this is why we don't trade retail concepts. And our price action will probably want to come back up and go in that direction. Okay, so that is trendline liquidity. So all you really need to know is that there are lots of buy stops resting above when there's a perfect trend line above, and then lots of sell stops resting below. Now, one of the ways you can use liquidity in the market is actually by putting your take profit there. So let's say we had equal lows below or equal highs above. That is the next type of liquidity we're going to talk about, okay? And let's actually use a live example for this version. So, as you can see, right here, we have, do we have 5 minutes? No, we have 1 minute equal highs. Now, when it comes to trading, one of the most important things that you need to learn is using different time frames, okay? So right now we are on the 1 minute time frame, but you can use a 2, 3, 4, 5, 10 minute, 15 minute, 1 hour time frame, okay? And with liquidity, the higher the time frame, the more strong the liquidity is, if that makes sense. So let's say we have equal highs here on the 1 minute time frame, okay? But we don't actually have them on the 5 minute time frame. It's just a swing high. Therefore, this liquidity is not as strong as it would be if there was equal highs on the 5 minute time frame, for example. So always keep that in mind when you're trading, and make sure you check the different time frames, okay? So as you can see right here, we have these equal highs. So what does this mean in price action? So all equal highs actually mean excuse me. So all equal highs actually mean is just when the price action has came to the same point in the market more than once and hit the exact same point of price without swiping the liquidity. So it looks something like that, and then you have just hit the same point twice, and then obviously here we have lots of buy stops resting. So this is called buy side liquidity, okay? So that there's lots of liquidity sitting up here where price action might want to take and then come back down, or it can still head in the same direction, okay? So equal highs are actually my favorite type of liquidity, and the reason for that is because they are a very, very strong draw on liquidity. There will be a lot of stop losses resting above here. So let's say if I was to enter a long position down here, my target would definitely be these equal highs right here, just because it is a very, very important area and a very strong area of liquidity. Now, yeah, I might target there, the swing high, just to take partials, but my main target would definitely be these equal highs, just because equal highs are my favorite type of liquidity. I find that they hit the most in trading, and yeah, if you play at the price action, as you can see, price comes up, it sweeps the liquidity, and I actually don't know what it's going to do now, and yeah, and then it ends up going back down, okay? So you see how price just comes up, sweeps the liquidity right there, so right here where all the sell stops are resting that I just said, and then price goes back down and stops out all of the traders that had their stop losses resting there. Okay, so now the final type of liquidity, which is swing highs and swing lows. Now this is the most common type of liquidity, and really where you'll be finding most of your exits. Okay, so it's pretty self-explanatory. All swing highs and swing lows are just swing high and swing lows, and then the liquidity is there. So let's say here, for example, I'm using a 5 minute time frame. We have a swing high right here. So all the swing high is when price action comes down and then back up, and it creates like a little point, or vice versa for sell side. So that would be buy side liquidity right there. This would be sell side liquidity right here. Okay, so you'd mark that out as sell side liquidity. You'd mark this out as buy side liquidity. Okay, so now this is called swing high and swing low. Now you'll see people getting their bias a lot from these type of liquidity pools. So as you can see, they are quite in a important area. Let's say we have a nice swing low here and a nice swing high there. So what people do with the swing highs and swing lows liquidity is they will find their bias. So let's say price comes up and sweeps this liquidity, then people might think, okay, now that this buy side liquidity is swept, we have got a very high chance of us coming to the sell side liquidity. Okay, now obviously you wouldn't just blindly short it or long it depending on which liquidity is taken, but it is a very good indication if we get a wick above one of these liquidities. Let's see if we get it actually. I have not seen this price action at all, so I don't actually know what happens here. But let's see what happens. If we get a wick above one of the liquidities and then it takes and then it doesn't displace above, and I've accidentally clicked off it, so never mind. So what I mean by that is, let's say we have a high right here, we have equal highs right here, okay? Instead of price action coming up and getting a strong candle close above here like that, that would be called displacement, okay? When we get displacement, that means that price might want to carry on going up. Now, we can't really use that when we are trading, okay? Unless that is your trading model, of course. But what I like to do is wait for liquidity sweeps. Now, what that means is, let's say we have these equal highs right here. As you can clearly see, we have these equal highs. Now, what price might want to do is come up and wick this high. So what I mean by that is price will come up, it will not close above, it will just put a wick in there, and then the candle body will actually close down here. Let me find you guys an example. Okay, so right here, for example, we have these equal highs right here on the 15-minute time frame, so they are quite important. But as you can see, what price has come up, it has came and price has swept the liquidity. It has took out the liquidity with a wick, and then it is carried on going down in the direction. So lots of people would have been stopped out here, but then price didn't actually carry on going in that direction, and it actually just came down. Okay, so you'll see that happening a lot, and you can incorporate this into your trading strategy. If you have wicks and then you want to target opposite sell side liquidity, that is very good. I do that myself. Now remember, if you want to join my Discord, I live stream every single day for completely free. So make sure you join that. The link is in the description. And yeah, thank you guys for watching.